What's the quality of the bond? Does it carry a rating? You know, the rating companies have a lot of egg on their face right now because of the problems. You know, they rated all these subprime mortgage securities AAA, and look what happened. So it's just a starting point to consider with a bond investment. Again, the issuer and your confidence in the financial stability of the issuer is the #1 factor to consider. With bonds, you should never pay a commission, an extra commission. The bond traders make their money by including their markup in the price that you pay.
Should a retail customer buy their own individual bonds?
I would say in certain circumstances, yes. You know, if you live in a certain town and your community is issuing general obligation bonds to fund you know, some type of civic improvement, and you're comfortable with your city's finances, it's a great thing to have in your portfolio.
But if they get a call from Smith Barney, should they be buying individual bonds?
As a rule, probably not. No. But occasionally, you know, your communities will come out with bond issues, and you know, they can be very nice additions to your portfolio and help enable you to support your community. With bonds, like with stocks, there's a bid-ask spread in the pricing. What does that mean? There's two prices, depending on whether you're a buyer or a seller. All right? If you're buying, you're going to pay the ask price. If you're selling, you're going to ask for a bid. If you have bonds in your portfolio, if you have individual bonds in your portfolio, especially if they're long-term bonds right now, take a look at the prices. They're probably near record highs, and it may be a smart time to seek some bids. All right, we always get 3 bids when we go to sell a bond and take the highest one. So probably not a bad time to lighten up on your long-term bonds. Okay. All right, in regards to munis. Historically, munis have one of the lowest default rates of any types of bonds. Much lower than corporate bonds. Less than 0.5% of all munis have ever defaulted. But we're in some interesting times today. There's a lot of pressure on not only the state government, but also, you know, local governments. And so it's more important than ever to keep tabs on your issuers and know what's going on with their finances. You know, the 3 main types of muni bonds out there are general obligation, which means that those are backed by the full taxing power of the issuer. And they are considered the safest types of munis. Revenue bonds are also very safe. This would be like, you know, like a water or sewer revenue bond.
Toll road
bonds, where there's a dedicated source of revenue that's going to pay the interest and principal on the bonds. The riskiest type of muni bonds, where the pricing is very attractive right now, are land-based tax-backed bonds. These are also referred to as Mello-Roos bonds. Newer developments, you know, issue these bonds in order to fund infrastructure for, you know, street, sewers, all of that. And then there's an assessment that is made to each homeowner, which pays off the bondholders. Again, if you know a certain area, then you can feel more comfortable buying those bonds. Areas that were developed in like 2004, 2005, that issued these Mello-Roos bonds, there could be some significant problems down the road as homeowners default. But it would more than likely just be a temporary event because those payments stay with the property. Anyone that comes in to take over a foreclosed house has to make those payments whole. We typically will put bonds, muni bonds, of course, go in your taxable account. So your joint account, your trust. How many in the room have living trusts? Good. Hopefully everybody raises their hand. Your living trust account is where you buy muni bonds. And again, if you're a higher bracket payer, if you're in like the 25% or higher federal bracket, you add 9% state of California on top of that, all of a sudden a lower coupon on a muni bond looks very attractive in that type of tax bracket. So otherwise, we typically will put all of our bonds in the IRA account. For most clients, we handle 2 or 3 accounts. There'll be like a trust account, living trust account, and then an IRA for the husband and IRA for the wife. So your bonds are better placed in the IRA accounts. And why is that? Because except for tax-exempt munis, all the interest on the bonds is taxable if you have it in your trust account. If you have it in your IRA account, what happens? It's tax deferred. It's tax deferred. So all those interest payments that come in, you just accumulate, and then when you hit 70 and a half, you start taking out your required minimums.
So a person portfolio, they should look at it as one big investment pool and divide the bonds up into the IRA accounts as much as possible.
As much as possible.
Okay.
As much as possible. It also depends on a person's allocation. If they're at like 20/80 with 20% equities, we would look to put the 20% equities in the trust account, but more than likely, the 80% is going to also include some bonds in the trust account. So anyway, the point with the munis are that it started unraveling like in the 4th quarter of last year, November. Prices dropped and continued to drop into January. There was a 60 Minutes interview. I don't know if any of you saw it with this analyst named Meredith Whitney, and she put tremors through the muni bond market, talking about potential defaults, and that exacerbated the price declines. But in mid-January, prices bottomed, and we've been gradually coming back up since then.
Are you buying municipal bonds today?
We've been buying them steadily over the last couple months because the prices really came down. And again, you just have to pick and choose your spots carefully. But
I remember tax bracket, correct?
Yeah. So, but there are still opportunities. The Build America program ended on December 31st. There are a lot of these bonds out there in the secondary market. So that's where you'd look for those now. There are a few new issues still coming that were authorized prior to December 31st. But by and large, the Build America program is over. Preferreds. Again, these are like long-term corporate obligations. All of the biggest corporations in America have issued these securities. They trade on the New York Stock Exchange. They're issued at $25 a share. They are long-term debt securities. So 30-year typical maturity, and some have a perpetual maturity. So I talk about extending duration. You get a higher yield with a preferred than you do with a bond. They pay quarterly taxable dividends. These dividends do not qualify for the favorable tax rates, by the way. So these are non-qualified dividends. So these, if you own these are best held in an IRA type of account. We have sold pretty much all of our fixed rate preferreds because they're selling now at premiums. Most all of these are over $25 a share. There are some floating rate issues out there that still make sense. We own one issued by Goldman Sachs. It's paid about 4% on the current yield, priced at like $23.50. So you've got 6% appreciation left to get back to par, plus the 4%. I think that's going to return about 10% over the next year. And so floating rates still make sense here. You've had a previous session on open-end bond funds, correct?
Yes.
Okay, so we'll just breeze through this. You know, if you're uncomfortable buying individual bonds, this is probably what you own in the bond area. It's a diversified pool, actively managed. The fund issues and redeems shares daily at the net asset value. Net asset value is simply the share price. Okay?
Please stick to Vanguard, void Franklin Templeton, void load funds. These are basis points in fixed income.
Unless you're working with a fee advisor.
Yes.
Fee advisors have the ability to buy certain load funds at no load at the NAV. With your open-end funds, you know, many people don't even know who the portfolio manager is. And to us, that's critical, very critical. You know, it's the skipper, not the ship. So, you know, the reason you buy an actively managed fund is because of the excellence of the portfolio manager. And you need to keep tabs on that and make sure that the person that created the track record is still the one that's there. The great thing about these open-end funds is they're so simple. They're easy to buy, easy to sell. You get a monthly dividend, which represents your percentage yield. And remember, the yields that are quoted by these are all net of expenses. All right? Please, please, please beware of chasing strong past performance, especially now, because interest rates have come down again. Bond prices are elevated. You know, you look at the quarterly fund summaries, and you see, oh, well, here's a top performer. You know, ask yourself, what are the chances of that performance being repeated moving forward? We always have to look ahead, think ahead. Don't get caught being a rear view mirror investor and getting hung up on past performance. You know, look at the share price. Where is it now versus the 52-week range? Is it bumping up against 52-week highs? If it is, maybe it's time to trim that off. Sell some of those shares. All right? These things do move around. It'll come back down, and then you can add more when the price is lower. Have realistic future return expectations.